Good afternoon, everyone. This is Jim Pearson on behalf of the Economic Justice Committee of the Civil Rights and Social Justice Section and the State Attorney General's and Department of Justice Issues Committee of the Section of State and Government Law. Welcome to the ABA webinar on abusive car loan and sale practices, scope and potential remedies to strengthen consumer protections. This latest webinar from the Section of Civil Rights and Social Justice. During the 2017-18 bar year, our goal is to rapidly respond to government action that may impact civil rights and civil liberties by offering free webinars, commentary, podcasts, social media posts, and other information from subject matter experts. We encourage you to check the section website, www.americanbar.org/CRSJ, our Facebook page, and our Twitter handle at ABA-CRSJ for more news and information and replays of our great programming. If you like our work, we invite you to participate and become a member of the section and collaborate with us on projects you want to develop and offer to our members and the general public. At this time, Ashley Taylor, my fellow co-host from the State and Government Law, I turn it over to you.
Thank you, Jim, and I would like to invite everyone listening to join the State Attorneys General Issues Committee, which is in the State and Local Government section. It is a committee co-founded with the Attorney General of Oregon some 3 years ago, and it's designed to provide an environment for practitioners in the space to discuss State Attorneys General issues in the context of a balanced discussion. So we always try to have someone from the State Attorney General's office and someone from private practice so that all perspectives are shared. We want to elevate the discussion and avoid the misperception that many people have that politics drive AG's decisions. And we have done so by putting on webinars, participating in webinars like this. We have conferences, we issue white papers, and so I wanted to encourage everyone to join. It's a long name, State Attorneys General and Department of Justice Issues, but it's focused on those practitioners who really have developed a niche expertise in this area. And with that, thank you, Jim.
You're welcome, Ashley. During today's program, you'll be able to ask questions of our panelists by clicking on your right-hand panel and choosing the question drop-down. We'll be monitoring the questions to ask during the Q&A portion of today's program. We welcome your participation. There are also 3 handouts available in the drop-down entitled Handout. All these materials will be shared with a recording of the program after the event. At this time, what I'd like to do is introduce our 4 panelists. We have experts that bring a great diversity of experience and viewpoint that we'd like to share with you. And the first will be Mr. Delvin Davis, who will present with respect to auto loan interest rate markups. And Delvin is from the Center for Responsible Lending. CRL is a nonprofit, nonpartisan organization that works to protect home ownership and family wealth by fighting predatory lending practices. Its focus is on consumer lending, primarily mortgages, payday loans, credit cards, bank overdrafts, and auto loans. Since 2002, Delvin Davis, who currently is a senior research analyst, has served in several capacities researching predatory lending practices and products. He currently is the lead researcher on auto car title lending. He's based in Durham. Delvin in 2014 authored Non-Negotiable, a study of the impacts of negotiation and comparison shopping for people of color. In 2013, he also co-authored Driven to Disaster, finding that car title lenders cost consumers $3.6 billion in interest annually. Thank you for joining us, Delvin. Our second panelist is John Van Alst from the National Consumer Law Center. National Consumer Law Center has used its expertise in consumer law and energy policy to work for consumer justice and economic security for low-income and other disadvantaged people, including older adults in the U.S. John is an attorney at the National Consumer Law Center, and he also directs the National Consumer Law Center's Working Cars for Working Families project. John has testified before congressional committees, and state boards about issues affecting low-income households. He also co-authors NCLC's manual on automobile fraud and contributes to a number of other consumer law manuals. He formerly was an attorney at Legal Aid of North Carolina, where he handled a broad range of consumer issues and was also an adjunct clinical professor at the University of North Carolina School of Law. Thank you for joining us, John. Shannon Kavanaugh is from the Commonwealth of Massachusetts, and we're very fortunate to have her with us today. She's the Deputy Chief of Consumer Protection Division at the Massachusetts Attorney General's Office. She's engaged in a variety of matters relating to student loans, automobile sales and finance, mortgages, and debt collection. Prior to joining the Massachusetts Attorney General's Office, Ms. Kavanaugh was a partner and co-founder of Klein Kavanaugh Costello LLP in Boston, which focused on national class actions and consumer finance litigation. During her time in private practice, Ms. Kavanaugh was a lead lawyer in cases challenging unfair and discriminatory mortgage lending practices, including class actions against AmeriQuest Mortgage Company, Bank of America, and Greenpoint Mortgage. Thank you for joining us, Shannon. And we also have with us Ashley Taylor. Ashley is a partner with Troutman Sanders, a large law firm, international law firm with over 650 partners. He's a partner in the consumer financial services practice with a primary focus on federal and state government regulatory and enforcement matters involving state attorneys generals, the Consumer Financial Protection Bureau, and the Federal Trade Commission. Ashley also founded and currently co-chairs the American Bar Association's Committee on State Attorney General Matters. He previously served as commissioner on the United States Commission of Civil Rights, appointed by President Bush from 2004 to 2010. Ashley also serves as editor-in-chief for the Consumer Financial Services Law Monitor and provides ongoing analysis and commentary on developments in the consumer financial services industry with a focus on regulatory developments. He's a prolific author and speaker, and thank you for joining us, Ashley. And I'm Jim Pearson. I'll be your moderator. I'm assistant professor of accounting and oversee the undergraduate and graduate programs here at Chatham University. And at this point in time, what I'd like to do is on behalf of the Economic Justice Committee, which we're very interested in, appreciative of our panel, I'd like to turn it over to Delvin Davis at this point in time. Delvin?
All right, thank you, Jim.
You're welcome.
So as Jim said, my name is Delvin Davis. I'm a senior research analyst at the Center for Responsible Lending. And in my time here today, I want to talk about a fairly pervasive but little known practice that's in the auto loan industry that's also known as interest rate markups. So to understand interest rate markups, we first have to understand the different kinds of loans that are in the market, primarily direct versus indirect loans. There are also loans that are known as buy here, pay here, which are both originated and serviced on site at the dealership. But for the purpose of this conversation, I'm just going to limit myself to direct and indirect lending. Direct loans are when consumers directly secure financing directly from their bank or credit union and take that pre-approval to the dealer as they go about purchasing their car. Indirect loans are when the dealer originates their loan after processing the consumer's credit and financial information. They then sell that contract to an outside lender that they partner with. So that might be a credit union or a finance agency, a captive lender, or some other third-party lender. This happens with the vast majority of the auto loan market. Over 90% of new cars are financed in this way, and about 3 out of every 4 used car purchases are financed this way as well. When a dealer arranges financing, it allows for additional revenue on the back end of that deal to be made, as opposed to the front end. The front end is basically the margin that is made off of the sale of the car itself. So if the car is worth $20,000 and you sell it for $22,000, the front end profit is that extra $2,000. The back end profit, those sources are primarily from the sale of add-on products and the interest rate markups, which I'll talk about later. And my colleague John Van Alst, he'll go into more depth on add-on products later on today. So if the average sales price of the average car, which is higher than it's ever been in history, I think the average sales price for a new car is approaching $33,000 for a new car, and around $20,000 for a used car. There's limited profit margin to be made on that front end, so that increases the pressure for a dealership to make up that profit on the back end instead through their F&I or finance and insurance department. And the F&I office is where all the add-on sales and the markups, that's where that happens. So this chart here just basically shows where the F&I department has generated a larger share of the profits for the average dealership over the past few years. So what is the interest rate markup? So to understand that, you have to see that the APR that is disclosed on your loan contract is made up of two different parts. There's the buy rate, and then there's the dealer rate markup. The buy rate is based on objective means, which would be your FICO score, your employment, your income, things like that. The rate markup is based on subjective means, which is purely to the discretion of the dealer. It can be different for every particular consumer that walks in the door, and it's largely up to the dealer to determine how much profit they want to make on that deal and how much they think the consumer can bear at the same time. So if you take a particular hypothetical example, say Mr. Smith comes into a dealership, he wants to buy a car, he allows the dealer to arrange financing for him on his behalf so he doesn't come to the dealership with a pre-approval. He'll fill out his credit application, does a credit check, turns it in to the dealer, and the dealer says, "Thank you very much. I'll take a few minutes to go over this, and I'll get back with you." And Mr. Smith goes to the waiting room and plays on his cell phone for a few minutes. So while Mr. Smith is waiting, the dealer will make a couple of phone calls. The first phone call will go to lender number one, and he'll say to lender number one, "We have Mr. Smith here. He has pretty decent credit, decent income. We can qualify him for a 3% interest rate." So that's the buy rate, what Mr. Smith has qualified for. So they'll tell the lender number one, "What can you do for me for this loan for Mr. Smith?" And the lender number one will say, "Okay, we see the credit and income. If you forward that loan to us, we'll purchase that loan at 3%. But if you forward that loan specifically to us, to our lender, we'll allow you to mark that interest rate up an extra points or 100 basis points. So instead of a 3% interest rate, Mr. Smith is now paying a 4% interest rate, a 3% buy rate, and a 1% markup." So the dealer will hang up the phone with lender number one and then possibly call lender number two and say the same thing that they told the first lender, the credit score, all the qualifying information. And dealer number two may say, "Okay, we see that lender number one had allowed for 1 point in markup. If you give that deal to us, we'll allow you to put 1.5 points on top of the buy rate." So the dealer will hang up the phone with them. "Thank you very much." And then go back to Mr. Smith saying, "Okay, we made a bunch of phone calls. We had to twist a few arms a little bit, but we got you this great deal at 4.5%. So what Mr. Smith does not know is that his credit qualifications, his income, his FICO score, qualified him for an interest rate which was much lower than what he's being presented on his contract. So the contract rate is what you're seeing on your TILA statement, on your contract being disclosed to you. And we've had polling surveys that say at least 2 out of every 3 consumers have no idea that this markup process is something that dealers can do. So there's a high level of unawareness that's going on with consumers in the market. And the whole thing creates a reverse competition where lenders are competing for the dealer's business as opposed to the consumer's business. So as the saying goes, wherever there is discretion, there is the potential for discrimination. And we see that here as well, given that the dealer has a lot of discretion in determining what the interest rate would be. Research from past class action lawsuits going back to the 1990s, the NCLC, National Consumer Law Center, was very instrumental in a lot of these earlier lawsuits. There was research found that both people of color, especially African Americans, Latinos, were both marked up at higher amounts and marked up more often than their white counterparts, even though they had similar credit standing. And as we see here, African Americans in these lawsuits paid average markups of $746, while white consumers, again, similar credit standing, paid a little less than half of that, $349. And African Americans were marked up 55% of the time, while whites were marked up 31% of the time. Now, since these lawsuits, lenders instituted these self-imposed markup caps of between 2 and 2.5% above the buy rate. But since those caps had been in place for a few years, the CFPB and the Dodd-Frank Act came into existence, and the CFPB also took it upon themselves to research and investigate this phenomena as well. And even with the caps in place, research from the CFPB over select some of the larger lenders in the industry, they still found discrimination and racially disparate data in some of the larger lenders that we have. And one of the first lawsuits and settlements that they closed with the DOJ was Ally Bank, that had to pay $98 million to 235 consumers that were harmed due to discrimination. So just recently, within the last couple of months, the National Fair Housing Alliance also did some qualitative research, sending paired testers where they would send a black consumer and a white consumer and have them both microphoned with recording devices on their person. So they were able to tape the entire conversation that they would have with the F&I professional as they were trying to negotiate and find out how much their deal was as they were buying a car. And 62.5% of the time, the non-white testers were offered more expensive financing options, even though they were either as creditworthy or slightly more creditworthy than their white counterparts. And if they were to accept the deal that they were offered, they would have paid over $2,600 more over the life of that loan, even though they had better credit standing. So one of the themes of this paper was, even though the testers were going into this car loan with pretty good information, they were fairly educated on the process, but they had a really hard time getting a lot of the details of this loan clarified from the dealer. So that just goes to show that the dealer has a lot of discretion, not only over the pricing of the loan, but what kind of information is shared as well, which comes to a head when the dealer can also throw in misinformation or misleading information that can also determine what can go on in this deal as well. So when you have misinformation that's put into this loan process, it hinders the consumer's power to negotiate or comparison shop for a lower interest rate. Center for Responsible Lending also did a consumer survey to measure the consumer's experience in buying a car. we found that that people of color that tried to negotiate their interest rate and comparison shop still got higher interest rates than their white counterparts that did neither. So even though Latinos and African Americans were negotiating and shopping at different places, you can see here from the graph that they got higher interest rates that, when compared to white non-Latinos that didn't do any comparison shopping or didn't try to negotiate their interest rate at all. So this does counter the narrative that the auto dealer industry would put out there that the interest rates are all negotiable. Well, any part of the car deal is basically negotiable. But if you were to just educate the consumer more and they would take more initiative to be more financially savvy and try to negotiate their rate as best as they can, it would mitigate any kind of disparate impact um, that we see with previous data from the lawsuits. But as we see here with this graphic, it counters that narrative that even interest rate um, negotiation and comparison shopping doesn't fully mitigate any kind of um, racism or racially disparate impact in this market. So this also shows from that same survey, uh, we also measured the misinformation that was told to the consumer from the dealer during the buying process. Um, Misinformation such as saying that add-ons are mandatory to purchase in order for the deal to be consummated. That the interest rate that they have is the quote unquote best deal available, um, which is blatantly false. And also if there was an unawareness if the rate was um, potentially marked up by the dealer or not. And any combination of these three events also correlated with higher default rates with late payments on those same loans. So it just goes to show that um, uh, any misinformation or manipulation from the dealer could create risk that doesn't necessarily need to be there. Risk from having a more expensive car loan than what your objective means, your credit score and your income would qualify you for. So if you have a more expensive deal, it makes it harder to pay off, and as you see here, more likelihood for late payments. And this is just an extension from the previous slide, using data from the American Bankers Association, which shows 30-day delinquency rates as well as repossession rates for both indirect and direct loans. So we see here the wide disparity between indirect loans, this is where the rate markups are happening, versus direct loans, which is where uh, the consumers are getting the loan directly from a credit union or bank, whatever financial institution that they do business with. And when you see the subjective risk from the discretion that the dealer has, um, it again creates more risk for delinquencies and repossessions from having unnecessarily more expensive cars. So responses from the industry, as I mentioned before, after the first um, uh, few lawsuits from the 90s and the early 2000s, the industry started to self-impose these rate caps of between 2 and 2.5% above the buy rate. Then the CFPB came and started to have these additional settlements from larger lenders. We mentioned LI Bank. They also brought settlements against Toyota. Uh, uh, I think Honda also had a settlement as well that was fairly substantial. Um, so BB&T, as well as BMO Harris Bank out of Chicago, they self-instituted these uh, a new way of compensating the dealer for the work that they do for originating their loans. So instead of uh, er, uh, so instead of compensating the dealer through a rate markup, they use a flat fee for all their car deals. So they instituted that in 2015. Since 2015, there was a large market share drop in the auto loan volume, and just in the past year or so, they've dropped 6% from fourth quarter 2017 from where they were in fourth quarter 2016. So that was from 14.2 billion down to 13.4 billion as of last quarter. So with that, that just goes to show that the dealers have a lot of discretion not only in how the pricing is going, but who they will and won't do business with. So they can easily shut out any particular lender if they aren't doing a rate markup structure. So with the CFPB gaining new leadership in late 2017, there's a different appetite for what the CFPB wants to do as far as enforcing ECOA, Equal Credit Opportunity Act lawsuits like they were doing in the past. So as of this year, early this year, BP&T officially dropped its flat fee program to reinstitute the rate markup practice that they were doing prior to 2015. So to close, just our policy recommendations at CRL, we encourage people to, one, enforce the laws that are on the books. The Equal Credit Opportunity Act, which is what the CFPB chose to enforce their discrimination, disparate impact that they were seeing with the data, as well as the Truth in Lending Act, what is and what isn't disclosed on the contracts, and also unfair and deceptive acts and practice violations. And this is all to encourage divorcing any kind of dealer compensation from the interest rate of the loan, which isn't to say that dealers cannot be compensated for any kind of work that they do, but not allowing them to have the discretion, which could lead to discrimination when they are financing car loans and interest rate pricing on those loans. And flat fees would be an adequate way to do that. So with that said, I'm going to pause there and turn it over to our moderator.
Thank you, Delvin. At this point, John Van Alst is going to present to us with respect to auto add-ons, and then thereafter, Shannon will present with respect to state and local enforcement actions of interest, and Ashley will close with federal response to litigation and regulatory activity in the auto lending space. And then after that, we'll do a little bit of Q&A. John, if you will, please.
Certainly. Thank you, Jim, and thank you, Delvin, and everyone else as well. I'm going to talk a little bit about the add-on situation when Delvin was walking through sort of what happens in the F&I office. He mentioned that in addition to basically selling financing to car buyers, they're also typically selling add-ons to car buyers as well. We had seen for years on an individual basis that there were really high markups on these add-ons, and there were a lot of different pricing depending on who was buying them. Last year, we did an analysis looking at over 3 million individual add-on products that were sold as part of 1.8 million car sale transactions with over 3,000 dealers across the country. And it allowed us to get some more, better view systemically of what's happening with the add-on sales. We saw four things primarily. We saw that the markups for the add-ons, the amount of profit that you are making on the add-ons is extremely high, that the pricing is inconsistent, and that inconsistent pricing leads to discrimination. As Delvin mentioned, when you see this discretion at the dealer level, that's typically oftentimes what we find happening, and that the finance companies play a real role in this. If we just look at, I think we're advancing now. Yes, if we just look at three different products we focused on, the data we had covered a lot of different auto add-on products, but we looked at service contracts, GAP, which are guaranteed asset protection coverage, and window etching. Here you can see on the state level what the markup is on the service contract. So that blue line is the cost to the dealer for these service contracts that they purchase from a third-party add-on provider. And the orange color is the amount that the dealer marked those up. We found on average across the country, dealers marked up service contracts about 83%. When we look at Gap, the markups are higher on a percentage basis. There was about 151%. And then when we look at window etching, the markups were much higher on a percentage basis. Now these, as you can see, the bottom line, the dollar amounts are a little bit lower, but the percentage markup was really astounding, 325% on average for the window etching. Dealers make a lot of money on the sale of add-ons, and these items are marked up incredibly high, especially when you compare them to some of the other sort of similar products. A lot of insurance products are oftentimes very similar. In fact, some add-ons sometimes are classified as insurance products. But most insurance products, when they're being sold, say like your home or auto, typically those are going to have a commission for the agent, which are going to be maybe 10 to 15% of the first year's premium. So that would be the equivalent of about 11 to 18% markup. Obviously much lower than what we're seeing here on the add-on side. And it wasn't just this one particular provider that has these really high markups. This is an ad from a few years ago at a auto conference for one of these third-party service providers. This one happens to be Safeguard. And you can see here they tout the fact that they had $600 million in claims paid and over $5 billion in profits for, quote unquote, our clients. Clearly their clients are the dealers. And the dealer profit far exceeds any amount ever paid to consumers under any of these add-ons. So the add-ons are really expensive, but we also typically see a lot of variation in the pricing. So we looked at the top 20 etch sellers and dealers by volume. So these are guys who sell a lot of etch products. And when we looked at those, we saw some real different ways in which they price things. So here you'll see that top dealer, number one, is a dealer in Connecticut. They sold a lot of these. They sold over 1,000 etch products just in 2012. It cost the dealer each etch product $16. They sold them on average for or not on average, they sold all of them for $189. Now that's an astounding, over 1,000% markup, but at least they were charging each of their consumers the same amount. I found out since that's actually because they're required to have to provide their pricing for their add-ons there in Connecticut in advance. Tennessee, we had another dealer who had a slightly different pricing scheme here. His cost for his etch products were $37, and he charged some consumers $199 and some other consumers $249. Another dealer in Kentucky, this is dealer number 3, had a cost for each etch product of $55, but he was charging people everything from $1 to $219 for this etch product. And then if we go down to dealer 4, and remember all of these are one of the top 20 dealers in the country for selling etch. This dealer had 2 different costs, and we can talk more about that later about why you might have that, but either $35 or $65, but his pricing was all over the map, from $1 to almost $2,000 for individual customers buying these etch products. So there's a lot of variation. We thought one of the reasons might be maybe it's the time of the month. Maybe you come in the wrong time of the month and they're going to charge you a lot more. So we looked at one dealer for 1 month at their etch sales. This dealer had a cost of $50 for each etch product. And you can see here, it wasn't really the time of the month. They're even the same day, you would have one person charged, $300 or $400 and another person charged $5,000 for this very same product. A lot of variation on who paid what. We looked at etch specifically because it's nice for most dealers. There's either just 1 or 2 prices, but this same thing happens with other products. It's just a little harder to see. So this is service contracts. That green line is where the cost to the dealer equals the customer charge. So basically they're making no profit at the green line, and anything above the green line, they're making a profit. This dealer, you can see, really liked a consistent $1,500 markup. Now, he had lots of other pricing in there. There's a lot of other marks, but you can see there was definitely a trend there. that had implications for people who were buying the cheaper service contracts, probably people with cheaper cars. They got marked up on a percentage basis a lot more. Another dealer, this one really liked charging either $19.99 or $24.95 or $29.99. There again, it has implications for people buying the cheaper products because typically it's both a higher absolute markup and a higher percentage markup on those. And some of the dealers use both. Here, I don't know if you can see it, but there's both a trend there for the $1,000 and $1,500 markup as well as right around $29.99 and $24.99 and whatnot. Outside of just these trends, dealers had a huge variation in how much they were marking consumers up. Here you can see I'd much rather go to the dealer in green than I would the dealer in red in terms of what you're paying for these products. So there was a lot of variation from one consumer to another on the pricing of these products. And as we said before, oftentimes what happens is when we see this variation, we see it leads to discrimination. So we looked at service contracts because they were one of the products that was sold in almost every state, and we had a lot of data for service contracts. We looked over a 3-year period, and we had service contract data from 48 states in the District of Columbia. And when we looked just at the average, well, let me backtrack just a little bit. We didn't have race data for this, but what we did have was surnames for all of the people who had bought these products. And the Federal Reserve Board has used in the past the census data on surnames to get kind of an idea of who's buying things and how much they're paying for them. So we use that same FRB list of Hispanic surnames and coded all the people in our data set. And then we looked at the difference between folks who had Hispanic surnames and folks who didn't. And like I say, we had 48 states in the District of Columbia where we had service contract sales over this 3-year period. And out of those 44 states, the Hispanics were charged on average higher markups for service contracts than were the non-Hispanics. In 2 states, the markup was lower for Hispanics, and in 1 state, in the District of Columbia, there was no Hispanic service contract buyers at all. But we were anxious to really make sure we had very sort of clear and reliable data. So we restricted what we looked at. We only looked at places where there were at least 30 Hispanic service contract purchasers. And we then applied statistical testing to make sure we had statistically significant data. And when we did that, we got this set of states. And of those, as you can see, this is the absolute markup. All the states except Florida, Hispanics, that's these orange lines, were marked up greater than non-Hispanics on an absolute basis. On a percentage basis, the same thing, every state, they were marked up higher, including Florida. Now, one of the issues may have been Hispanics were being sold cheaper service contracts. Maybe they were buying cheaper cars. So we limited just looking at service contracts that cost between $910 and $1,010 because that's right around the average. And even when we did that, so these are all people who are buying service contracts that cost the dealer the same amount, we still see all the states except Florida, the absolute markup was higher, and except for maybe Kentucky, it was almost exactly even. And then the percentage markup, there again, states except Florida and Kentucky, it was higher for Hispanics across the board. We also thought maybe they're just going to the wrong dealers. So we looked within dealerships. These are 6 different dealers in California where we had statistically significant results. And there again, we see Hispanics were charged both a higher absolute markup as well as a higher percentage markup for their service contracts. Part of the role here is not just dealers, but it's also finance companies. Delvin mentioned their role in the interest rate markups, but they too have a role in the pricing of add-ons. So typically when a finance company is dealing with a dealer, there'll be a rate sheet that basically says how much can the dealer have on the back end in total. A lot of times they'll even be very specific. They'll say, you know, you can do up to $2,000 for a service contract or up to maybe $3,000 total back end for service contract, gap, whatever, or sometimes they'll say you can do up to $1,000 for Gap or things like that. We were able to gather data from Ohio on which finance companies had financed these transactions that we had. And this chart before you right now is basically just a chart of all the different finance companies that were financing these deals in Ohio. The smaller ones are smaller finance companies. We couldn't squeeze the names in. But basically, you can see it's a really diffuse market. There are a lot of different auto finance creditors here that the dealers can turn to. These were all the ones for which there were transactions that Gap was being sold. So there were a lot of different auto finance companies that financed the deals when dealers were selling Gap. But if we look at ones where Gap was over $900, you can see that Ally has a very much larger percentage of the market share. Clearly, they are allowing these $900 and up Gap products, and the other finance companies aren't. Now, one possible explanation there again is maybe Ally does a lot of Cadillac financing or something like that. You know, maybe they're financing the really expensive cars where Gap's going to be higher. So once again, we limited this, only looking at deals where the dealer cost for the Gap product was $150 to $250. Again, you have a wide array of finance companies that finance these transactions. But if we look within that subset where the dealer cost was $150 to $250, just where the Gap product, the charge for the consumer was over $900, again, we see Ally has a much outsized market share. We looked at all these sort of abuses and problems and have three recommendations, really. One is that dealers should be required to post the add-on pricing for all the add-ons available on the car, somewhere on the car in the lot, along with the price of the car. So consumers can see up front what these products are going to cost. And that would, obviously, we also say that it should be a non-negotiable price. And the fact that it's non-negotiable will certainly, get rid of this discrimination we've seen, and the fact that it's actually posted on the car will let people see up front, what these things are going to cost. We also are anxious that ECOA, Equal Credit Opportunity Act regulations, should be amended to require documentation of a customer's race or national origin for non-mortgage credit transactions. These auto transactions are really the only one left where you've got a person across the table from you who can see you, deciding what they're going to charge you for an interest rate and what they're going to charge you for an add-on and all these sorts of things. And we can't really monitor that unless the creditors and enforcement entities and others can take a look to see what the race is of people that are being charged these different charges. And finally, state and federal enforcement authorities should certainly investigate this discrimination and the other abuses that we saw as well in terms of pricing add-on products and bring enforcement actions. I think I'm going to run over my time, so I'm going to turn it back to Jim.
Thank you, John. I appreciate that. That was excellent. And then Shannon, if you would please, why don't you provide us perspective from the Commonwealth of Massachusetts as you see it in the enforcement settlements?
Sure. Thank you, Jim. So one of the Massachusetts Attorney General's office's top priorities is economic security, and a huge component of that is automobile affordability, especially for low-income consumers in Massachusetts. About 85% of commuters in Massachusetts drive a car to work, and surprisingly, even in the Boston area, about 75% of commuters drive their car to work every day. So if a car is unaffordable or inoperable, then that impacts especially low-income consumers needing to use the car to get to work every day. The number one complaint our office receives through our intake division is about defective automobiles. We have various divisions in the office that handle the bulk of our automobile matters. As Jim had mentioned, I'm in the Consumer Protection Division. We're charged with conducting investigations and enforcement actions under Massachusetts consumer protection statute, which is 93A. We're lucky here in Massachusetts that we have a very strong consumer protection statute and have been able to use it to get significant relief and remedies for consumers here. We also have our insurance and financial services division that also conducts investigations and enforcement actions under 93A. They have a particular focus on auto insurance products, but they also generally look at automobile finance issues as well. And the intake division that I had mentioned is called the Consumer Advocacy and Response Division, and they're a hotline, and they field thousands of phone calls every week, and they try to act as an intermediary between the consumer and the automobile dealer or automobile finance company to see if they can informally resolve the consumer's concern or the consumer's complaint directly with the dealer. Certainly, we receive, as the Consumer Enforcement Division, will receive information about what the card unit sees in terms of patterns and practices that they hear about through consumer complaints, particular dealerships or finance companies that may not be as responsive or helpful to resolving consumer complaints, and that informs some of the investigations we bring in our enforcement actions. There are a few other relevant Massachusetts state agencies that are involved with overseeing automobile finance companies in Massachusetts. We have our Division of Banks, which has examination authority and regulatory authority over automobile finance companies. They are required to be licensed in Massachusetts. And the Division of Banks is within the larger Office of Consumer Affairs that generally does consumer outreach and education on the state's lemon laws. There are a few recent initiatives and enforcement actions by my office that I think sort of nicely cover a lot of the areas that John has already recently touched on. Most recently, we sued a buy here, pay here company. It's known as VentureCap. It's a national franchise, and here in Massachusetts, it does business as JD Buyrider. And as Devlin had mentioned earlier, in the buy here, pay here context, that's when the automobile dealership has an in-house finance company that it uses to provide financing to the customers that come in to purchase its vehicles. We filed the case after a couple of years of investigation in September 2017. And we allege that JD Buyrider has engaged in unfair and deceptive acts and practices towards Massachusetts consumers, both in terms of its advertising and alleged misrepresentation to consumers relating to the cars and to the financing that it provides, and in addition to some of the add-on products that it offers. And also, more generally, we're alleging that the whole package that JD Buyrider offers, it's a uniform package for each consumer, and that 50% of the times that package ultimately fails and ends in repossession, whether it's involuntary or voluntary repossession, or if the consumer never even makes it into the regular loan payments because he or she is unable to afford the upfront deferred down payments that JD Buyrider requires on all of its deals. The components, generally speaking, there's multiple components to this package, but it includes the sale of the car, the financing of the car, and the repair service that JD Buyrider offers. They have repair centers on site, and they offer an extended service contract to consumers, and the consumers are required to use JD Byrider's repair site to get the benefit of that extended service contract. Notably, although JD Byrider's position is that it offers the extended service contract to consumers, and certainly, there are disclosures that indicate that it's an optional extended service project. It's notable that 98% of the consumers who've purchased a vehicle from JD Byrider have the extended service contract. We allege that the cars sold by JD Byrider are poor quality cars. We reviewed various data that we obtained in the investigation, and we allege that 42%, up to 42% of the cars have to go into for repairs within just 3 months after purchase, and that excludes just routine oil visits. And we also allege that hundreds of cars actually suffer from a mechanical breakdown shortly after purchase. The loan that is offered by JD Byrider's in-house finance company always comes with an interest rate of 19.95%, regardless of the consumer's credit qualifications. We allege that consumers are unaware of the loan terms until they've gone through an extensive sales pitch and, have spent a long time at the dealership and are finally sitting down to sign the paperwork. The extended service contract that I mentioned comes at a price of $1,300. That is also a uniform price, and consumers are sometimes unaware that they've even purchased the extended service contract because it's bundled into the principal balance of the loan, and they're financing that service contract at the 19.95%. We allege that, the benefits to the consumers under the extended service contract, which also requires a $50 deductible each time it's used, are questionable as well, of questionable value. We also are challenging JD Byrider's underwriting policy with respect to its high-cost loans, that it engages in a extensive budget analysis for consumers, but uses estimated payment amount, estimated numbers for certain components of consumers' expenses that don't accurately capture the actual amount of that cost to consumers. And because its policy is that it will it'll approve a consumer for a loan up to 100% of that consumer's expense to income ratio, there's no room for error. There's no cushion for unanticipated expenses, or, as we've alleged, if JD Byrider uses estimated numbers that are that are lower than what the actual cost is, that frequently puts consumers over the 100% expense to income and squeezes their budget. Just by way of example, we allege that JD Byrider had underestimated the actual monthly payment amount on the car in the budget analysis, even though it prices its cars at a uniform price and even though its loan terms are uniform, so it has information at hand that should have allowed it to accurately estimate the amount, or not even estimate, but to know exactly what the amount of the monthly car payment would be. We also allege that JD Byrider incentivizes its employees to misrepresent the terms of the deal to consumers, that its advertisements contain certain misrepresentations, that it incentivizes employees to push applications through for approval even if the consumer exceeds the 100% expense to income ratio, and that it incentivizes its repair service team to spend less money and on parts and labor for pre-sale reconditioning on the cars. In other words, the less they spend in time and money reconditioning the cars, the higher their potential bonus would be. And so ultimately, based on the alleged high repossession rate and the number of consumer complaints we received in the office during the pre-suit investigation as well, we allege that this package is structurally unfair, that it's not designed for consumer success, it's designed for profit, and that consumers just don't have the ability to succeed on these deals. I mentioned, the repossession rate, but there's also a much higher default rate as well. And just by way of very quick background, some context for this claim, several years ago, a similar claim based on structural unfairness of a loan in the mortgage context was brought in Massachusetts. And my office, it was the Fremont case, where my office had alleged that certain components associated with the mortgage loan caused that mortgage loan to be doomed to fail. And the court in that instance had found that loans containing 4 characteristics were presumptively unfair. And that included an adjustable rate that would adjust after 2 to 3 years, a teaser rate that would rise more than 3% once the fully indexed rate was in place, a loan-to-value ratio with 100% at 100% or more, or a prepayment penalty, and underwriting that focused on the borrower's ability to pay based on the teaser rate versus the actual fully indexed rate. So there is some jurisprudence that in Massachusetts under our consumer protection statute that relates to unfairness when a loan has multiple components or a deal has several components that would result in large volumes of consumers not being able to pay. That case is in discovery right now, and we're moving forward with discovery. Another area that we have been looking at has focused on finance companies that fund dealerships who engage in a pattern or practice of selling defective cars. One of the primary reasons that consumers are unable to pay their auto loan is if the car that they purchased is not working for the purposes that they need it for, or if they're required to do extensive repairs that are unanticipated and costly for them. So when we are looking at automobile sales issues and sales of defective vehicles, there's other factors that we look at too when we see what types of finance companies are financing these cars and these dealers. And if we see a finance company that's been in business with a problematic dealer that has a long history of selling bad cars, and they're offering, they're purchasing retail installment sales contracts, with certain terms that are high cost terms like 21% interest rates or significant add-ons, and there's high repossession rates for that particular finance company and dealer combination. Sometimes what raises an eyebrow is if there's a recourse agreement between the finance company and the dealer where, if a loan doesn't perform, the dealer effectively has to buy it back, which we would claim disincentivizes the finance company to make sure that it is working with dealers who transact sound contracts with consumers. And if there's factors which show that the finance company hasn't overseen, their dealers or monitored their dealers to ensure that they're not engaging in unfair and deceptive sales practices, then that's a fact pattern that raises an eyebrow for our office. And so as we're sort of working through the bread and butter issues associated with the sale of defective cars or lemons, we also look at the finance companies that are funding those dealers. We anticipate a settlement to be public soon on this that would give restitution to the consumers affected and forgive deficiency balances, and also provide credit repair. All of the deficiency balances and the credit repair, which is primarily in control of the auto finance companies. Similarly, along that line, with respect to being in business with dealers that the finance company knew or should have known was engaging in unfair practices, or in this case, outright fraud. In 2015, my office settled a major case with Santander, which is one of the largest securitizers of subprime loans in the country. And here, the dealerships were literally inflating the income on loan applications that it was submitting to Santander for approval. And Santander had a pretty robust and sophisticated system to monitor those dealers. And in fact, they had audits for some of those dealers showing that the dealers were inflating income and showing that their systems for overseeing them were inadequate, and even had identified some dealers as fraud dealers, but nevertheless continued doing business with them and continued securitizing those loans. Our office worked in conjunction with the Delaware Attorney General's office and settled the case for $26 million. $22 million went to Massachusetts, and we used approximately $16 million of that to help more than 2,000 Massachusetts drivers pay off their car loans, and to otherwise help them with their auto loans. Real quick, because I don't want to press up on anybody else's time, another area that we've generally looked at is usurious loans in Massachusetts. The cap on retail installment sales contracts is 20%. So in 2015, we also settled a series of cases, one of which was also with Santander, for failure to include gap coverage. Gap is a product that's intended to bridge the gap between when there's a total loss on the vehicle, what the auto insurer pays out, and what the borrower continues to owe on the loan. And Santander failed to include that as it was required to do as a finance charge. And so when you plugged the gap cost into the finance charge, as it should have been on their high rate loans, it tipped their loans over the 21% usury cap. So in that case, there was a $5.4 million settlement, and Santander forgave the outstanding interest on the loans of consumers who were affected and reimbursed consumers for the interest they had already paid on the loan. Last but not least, with respect to auto title lending, a little bit of a different issue, also implicating usury laws here in Massachusetts. We settled a case with an auto title lender in 2016 called Liquidation. We originally got a preliminary injunction against them. They were extending loans with auto titles as collateral at percentage rates ranging from 181% to 619%. far above our state's usury, criminal usury statute and also small dollar loan statute. And in that case, we got a judgment voiding the loans for over 200 Massachusetts consumers. One quick last note I just want to make is in Massachusetts, too, we have very strong debt collection regulations, which also apply to original creditors. So in some instances, if a auto finance company is collecting on their loans, they could be liable if they're not collecting on those loans consistent with our debt collection regulations. And with that, I'll hand it back to Jim.
Great. Thank you, Shannon. Really appreciate that perspective and coverage of the settlements. At this time, Ashley Taylor, turn the mic over to you, please, and provide your input to us. You want to make sure your mic's on, okay, Ashley?
Great. Are you able to put up my presentation, or is someone from the ABA putting that on the screen?
Somebody at ABA is. Paula, you have that up?
Well, I'll jump right in because I'm looking at our time and I want to make sure we reserve 15 minutes for Q&A.
Sure.
So let me move forward here. For our listeners, what I will try to do is to bring some order to this regulatory landscape, and I would encourage you to think of this discussion as sort of part two to what you heard with respect to Massachusetts enforcement actions, because in order to make sense of the regulatory environment, you must think about four distinct players: the states, CFPB, DOJ, and FTC. And historically, a webinar of this nature would have started perhaps with the federal government. But in this modern day of active AGs, it's frankly more appropriate to start with a discussion of what's happening at the state level. And to give you a way to think about this more simply, if you look at the settlements from the Department of Justice and FTC, those tend to be very large settlements which take a lot of years, and they involve very large companies, but there are not a lot of them in terms of the absolute volume. At the state level and with respect to the CFPB, there are a lot of settlements, and those settlements tend to be very detail-oriented, and they tend to really outline the compliance issues for a company to consider. And to give you all some context, I actually was in the Attorney General's office as a deputy AG for a number of years, and so I come to this practice with that experience and understanding the importance of advising companies to consider the details of a settlement action involving another company as you set your compliance protocol. The other thing I would emphasize is the collaborative relationship between the states and the CFPB and the CFPB and the FTC. Going back as early as March of 2012, then Director General Caudray actually attended a conference of the National Attorney General Association and spoke at that conference and discussed the importance of the two agencies, or the various agencies, working together. As folks in this call may recall, General Caudray actually served as the Attorney General of Ohio before becoming the director of the CFPB. So he brought his experience as a state attorney general to his position as the director of the CFPB. And when you understand that, you begin to understand why the CFPB and the states have worked so closely together. At this conference, he announced the drafting of a memorandum of understanding that the parties worked on, which really outlined how they would share information, how they would communicate, how they would coordinate on activities, how the supervisory functions and the enforcement functions of the CFPB would work in tandem with state AGs. The other MOU that I wanted to highlight is the MOU also from January of 2012 between the CFPB and the Federal Trade Commission. That MOU had several important points, the first of which was a specific section on the parties' discussion prior to commencement of any investigation. They actually laid out the process by which the CFPB and the FTC would coordinate prior to commencing an investigation, and they noted that absent exigent circumstances, there would be 5 business days of notice before they would commence a formal investigation. Again, laying out in detail in any public document how they would cooperate. This level of cooperation is important in the sense that we all want these agencies to coordinate so that when companies are dealing with an issue, they understand that while there may be overlapping jurisdictions, it actually benefits everyone involved if the agencies communicate and assign specialists to certain areas. Many of the issues that John, Delvin have talked about, specifically from the consumer's perspective, are very detail-oriented. And our experience has been that through these cooperative arrangements, when the regulators develop an area of expertise and begin to place in those areas of expertise or centers of excellence the responsibility for taking the lead in certain areas, investigations go much smoother. The other area that we wanted to highlight here was the area of a required notice prior to settling an action. That's a specific section in the MOU. And finally, there's actually a discussion of creating a computer system to share information, which sounds rather quaint in 2018 to talk about creating a computer system to share information. But at the time, that was a significant development, and it shows you how far we have come in just 6 years. Finally, there was a section, and this is something that will touch on several things that have already been discussed today, a section describing consumer complaints and how those consumer complaints would be shared. And since then, we obviously have the consumer complaint database that is shared, but you can see the foundation of this process in the MOU back in 2012. Now, any discussion of the CFPB would not be complete without a discussion of the then and now. And so CFPB is characterized and loved by some, arguing, and I'm picking this quote up from a few media publications, that it's been making, quote, a real and lasting difference that has improved people's lives, while the critics have argued that it is the single most powerful and least accountable federal agency in all of Washington. And you can see that philosophical tug of war taking place in the context of the Trump administration, where the interim appointment of Mick Mulvaney as acting director came after an effort by General Cordray to appoint Ms. English, his former chief of staff, to the position. And that issue is not something I'm going to dwell upon, but it's an issue that still is is in the middle of litigation in the District of Columbia District Court. I wanted to highlight the philosophy differences, and I thought I could do so by stating the mission statement from General Cordray. Quote, the Consumer Financial Protection Bureau is a 21st century agency that helps consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. A shortened version of that you have seen as pushing the envelope in enforcement actions is the phrase that has been used. Director Mulvaney came in and immediately issued a, quote, new philosophy, that it will address these issues, but it will do so in such a way in which it is not, quote, pushing the envelope, which was read as a direct response to the mission statement as outlined by Director Cordray. But that tug of war at the leadership level we have seen has not necessarily played out at the staff level. As you might expect, with a staff of over 1,000 in CFPB, their work continues. They continue to be active on the supervisory front. They have been less active on the public enforcement front since the acting director has taken over. But we expect that to be a pause rather than a stop. This has created an environment, however, where state AGs have been viewed as needing to fill the gap. And you see statements from a number of AGs, including California, New York, and Massachusetts, and Virginia, that expressly state their job, they view their job as filling the gap. One area in which they haven't had to necessarily fill the CFPB's perceived gap has been in the area, though, of auto loans, where just in November of 2017, the CFPB issued a report on the increase in auto loans, and they focused on 6 specific areas. And I just want to identify those areas in the short time I have here, because those are the areas that we would encourage companies to focus on with respect to compliance issues. monitoring consumer complaints, and ensuring that their compliance management system is responsive to those complaints in a manner that if a regulator were to ask the question, they can demonstrate appropriate responses. The areas would include the term of the loan, and the CFPB noted that the terms of the loan are becoming much longer, focusing on the increase of the loans with respect to consumers with lower credit scores, the absolute size of the loan. I think as Delvin mentioned, the price of an overall vehicle is continuing to go up, and the amount of the loans reflect that increase, and the higher default rates, which apparently is, according to the CFPB's report, occurring across segments and ethnicities. I'm looking at our time here, and I want to focus, if I could, on the takeaways at the end. Well, if you will move that down to the end. Right. So the takeaways here, so we can jump right into the Q&A, is for a company or a compliance officer to understand the landscape. And you can only understand the landscape by reviewing in detail all of the public settlements from these four bodies that I just mentioned. Historically, compliance officers would have focused on the statutory language and the plaintiff's cases, but those, as we all know, are often private and confidential, but the public settlements are not. And if you have a compliance management system which focuses on the public settlements, it really gives you a roadmap to areas that will become the subject of focus in the future, because these regulatory matters tend to be driven by consumer complaints. The next takeaway is to develop a monitoring system, and this is something that needs to be developed specific to the industry and specific to the trends as set forth in the settlements we just discussed. We cannot overemphasize the need for a robust compliance program and the need to document your compliance program in a manner that you can demonstrate appropriate efforts if asked. Recognize overlapping jurisdiction of the agencies, but also recognize that they are working in a collaborative manner and have really worked out a system. You can see this, if I had more time, I'd talk about this in greater detail, but you can see this in joint settlements. You can see this in tag-along efforts when there's a settlement with the CFPB and then maybe the FTC or the state AGs pick up the next issue. But while there may be overlapping jurisdictions, there is clear coordination, and you don't see overlapping investigations. You see more of a coordinated effort and a joint effort. So if a company is faced with an inquiry, it's appropriate to think through all of the issues and assume that the regulators are coordinating, and you need to think about it in a holistic way. And finally, we emphasize cooperation and transparency. You always want to cooperate. You always want to be transparent. And you always want to work with someone so they understand the details of the business operation. We have seen so many of these cases go off the rails when there's a fundamental misunderstanding of the facts. And we're fortunate now in this more complicated environment that the regulators have significant experience with these business practices. And so, as I said before, they've developed centers of excellence. One place is Massachusetts, so they understand the details. And that actually helps you in an investigation because you want to work with an informed and knowledgeable regulator. Jim, I will pause there to preserve some time for our attendees.
Great. Thank you, Ashley, and thank you to each of the panelists for excellent presentations, Delvin, John, Shannon, and Ashley. Really appreciate it. At this time, I would ask our participants if they would like to submit any questions, please put them in the Q&A box. We'll be happy to provide them to the panelists for responses. And while we go through that process and await the questions, I will just kind of ask our panelists, there's been so much activity, and the acting director, Mulvaney, has indicated that he's looking to the states to step up, as Ashley and Shannon have indicated. In the area of the 2013 decision with respect to the GAO rescinding that or indicating that needed to be provided to Congress as a rule. Do you have any commentary on that from the perspective of what we look at with regard to statistics and analyzing disparate impact as we go forward to any of the panelists? Can anyone hear me, please?
I can hear you, Jim, and I'll maybe take a broader view of that in terms of, I think that if we take a step back, the biggest issue I think that we see in auto in terms of data and analyzing for disparate impact and all that is, something both Delvin and I mentioned, and that is the lack of race data associated with auto transactions. I think the rationale behind that in terms of ECOA was that we didn't want race data in front of decision makers, and so we said, well, we won't collect it for non-mortgage, but unfortunately in auto, it's an area where you have a lot of discretion right there, the person that's in front of the consumer, and whether it's, my guess is much of this is probably not, intentional maybe. I would like to hope that, but I think just given the state of our society and everything else that we see where this discretion at the dealer level, unfortunately the end result is we see, African Americans and other minorities charge higher interest rate markups, charge more for add-ons, charge more for the car themselves, just wherever there's an ability to make a decision at the dealer level, we see that plays out in a way that's really unfortunately unfair to minorities. And so I think the answer is we want to have good data. We've got to start collecting race data associated with these transactions. And in fact, it could be a lot more robust than HMDA data. We sort of self-limit HMDA data so that people can't find out too much about individual consumers because of privacy concerns. There are a huge number of these auto sales finance transactions compared to home mortgage transactions, and that would eliminate a lot of the concerns about privacy. So we could actually get a lot more sort of granular data about race in these transactions if we collected race data as part of these transactions.
Okay, thank you. Anyone else have additional impact? One of the questions that came in was, how does this data break down on race and gender? And some of the slides that Delvin and John have already shared have reflected that. Gender or age, any other criteria that you're seeing any linkage in? And Ashley, are you seeing any voluntary collection of data by the industry?
The short answer is no, Jim, to the voluntary collection of data. And I will tell you the hesitation that we have heard from our clients is not really precipitated by their concern from regulators as much as it is the private plaintiff's bar. There is a fundamental difference between the two entities. And to one of John's points, I was thinking during his comments about a number of settlements we have worked on the past couple of years, where the regulator has emphasized as part of the settlement the need to provide consumers with information and for the companies to be transparent. To your point, John, not necessarily accusing the company of discriminatory behavior, but recognizing that with improved consumer communication and transparency, a lot of these disparities can be eliminated. But unfortunately, that is not the perspective of the plaintiff's bar. And so the concern, I think, with this collection of data is that we aren't taking into sufficient consideration the real threat that companies face from the private bar, because those lawsuits are obviously driven by money versus the regulators' lawsuits, which tends to be driven by policy concerns and reimbursement of specific cost, as we heard before, rather than a lump sum payment to an outside lawyer. So the dynamics are different and they cause different concerns.
If I can just respond, I think both Jim and Ashley, in terms of the private bar, I don't really think, even if we had data, unfortunately, given the ubiquitous number of pre-dispute and in the transactions themselves, arbitration clauses. I don't really think that we see a whole lot of private bar activity in this area right now, unfortunately. We're really limited in that respect, and I would expect even if we had data, we'd really be looking to enforcement entities right now to take care of those. And Jim, to your question about gender, we haven't looked at that to my knowledge recently, but I will say, some of them, it's a little bit dated now, about 8 to 10 years ago, maybe even a little more than 10 years ago, some of the litigation did look at that and didn't see the same disparities in markups that we would expect. And, there might be a couple different explanations for that. I think at that time, our guess was that a lot of these transactions, you had maybe a couple going into the dealership together, but just one person's name on the retail installment sales contract. And so I think, some of those transactions, maybe we'd see different results today. And definitely if we could sort out, the folks that are going in individually, we might really see different results. But at the time, we didn't see the same disparities in terms of gender that we did in terms of race.
Okay.
If I may chime in for 1 second, just to say, from our office's perspective, targeting or disparate impact on vulnerable populations or minority populations, it's always on our radar. And John is absolutely correct that the lack of the collection of race data presents a hurdle in some of the analyses. We'll tend to look at in the auto space, we'll look at where dealerships are located. If it's a, company with multiple dealerships, we'll scrutinize any lead generators that dealership may use in order to solicit business and, emails or anything associated with, developing a plan for lead generation to see if there's any indicators in there that there's certain targeting being done. But it is a real challenge, outside, in my former life, we did the mortgage lending cases and the data was readily available to us. But these types of issues are always on our radar.
And in that, a final thought was, Delvin, any perspective you have as well with regard to Acting Director Mulvaney's comments recently of he wants to have more data-driven decisions going forward and more cost-benefit analysis. As a business person, that all makes perfect sense to me. But what do you see, though? Do you see a gap there, or do you see an area where that's being provided where we're not effectively using the data?
Well, in my experience, there is data there in the industry, but it's in 20 different places. You have different private vendors that will collect market level data. You can get some from JD Power, different credit score agencies also collect data, Experian, Equifax, and so on. Some are proprietary data that you would have to spend an arm and a leg to get access to. But there isn't a whole lot of publicly available, fully transparent data that is available for researchers like myself to take advantage of. So whenever there is an issue of discrimination or discretion, discrimination tends to thrive in places where data and transparency are thin. So I would fully advocate for, from a researcher's perspective, I appreciate the thought of having data-driven, fact-driven analysis, but to make that claim without making data transparent and accessible to researchers across the board, that's kind of a hard thing to keep the industry accountable, at least from a data perspective. So I would fully advocate for, I think what John was talking about earlier, a HMDA style type of data collection analysis, to have that available to researchers also from either from an enforcer's, federal enforcers perspective or private attorneys or nonprofit researchers like myself to be able to see it. So both sides are important.
Great. Well, I want to thank each of the panelists once again for your presentations And all our participants, thank you, and we look forward to seeing you on another ABA webinar in the future. Have a good day. Take care. Bye, everyone.